And why is it that it is better to being able to do the 20% upfront rather than paying? Because does it make a difference? Like, how much of a difference is if I put the 20% or if I choose to pay monthly?
We see that rents are so high. That was the point of paying rent. If you can qualify for a mortgage and buy a house, right? Yeah. That's how I see it. Yeah.
You gotta start somewhere, right? Because you want to. If you buy a house with 5% down, you're gonna build equity on that house, and then later on you can maybe give the 20%. But if you don't start, it's like homes keep going up, and things change so quickly. So I mean, it's a dumb thing to do.
I think that is so smart what you just said.
Yes,
yeah.
Like they're waiting for their dream house, and I mean, you gotta start somewhere. Hello everyone, I'm Daniela. This is Financial GPS. Today our topic will be mortgages. So all things mortgages, main points. We're gonna cover how to qualify for a mortgage. If you're looking to buy a house, this episode is for you. We're here with my husband, mortgage broker, and we're also here with our friend Alirio.
Yeah, well, I'm here today to talk about what are the main points to qualify for a mortgage, and I'm going to go over some specific points because I think it's really important for everyone to understand how we qualify a client, especially a lot of people they say that they got approved and closing they sign documents but they don't know anything else. So normally how I like to work, I like to explain my clients step by step because I want to show them what are they paying, and like I said to my clients all the time, I like to do things in a way that is going to help you to understand what are you doing and what are you paying. So basically I'm going to show you my screen, and this is an application that I work on, and it's going to show you exactly how much you can qualify for, what are the reasons that you qualify for the amount, and what are the reasons that you pay that rate. And also at the end we're going to explain what are the benefits of having a accelerated mortgage. Means that you're going to pay faster your mortgage. So I'm going to show you step by step, and we're going to go over. Yeah?
Yeah.
All right, perfect. Okay, so basically the first part, we're going to talk about GDS and TDS. So basically what is it? So basically GDS is the gross debt service, and TDS is the total debt service. So basically in the rule that we follow is that GDS, it has to be under 39, and TDS, it has to be 44%.
And that's a rate.
Right. So basically, what that's supposed to mean, right? It's basically on your income. So out of your income, out of the 100% that you receive, they're going to allow you to use 39% of that total for your house.
So it is not the full wage. So if you're making $170,000 a year, they only take 39% of that full budget salary to calculate how much you can pay.
How much you can pay,
To
exactly.
go towards the mortgage.
Towards the mortgage, yes.
Exactly.
Yes.
So GDS is the gross, right? So basically, it's talking about the house. Okay. What is the mortgage payment? What is the taxes? What's the insurance? If there's any maintenance, that's what the GDS is about. The total debt service is the mortgage plus your personal debts, and it only allow me to go up to 44. So that's the difference between the TDS and GDS, right? GDS 39, only your house. TDS, home plus personal debts. So they'll allow me to go up to 44%.
So that means that out of, again, the exercise of $125,000, the 44% out of my income, that is what's gonna basically be my allowance, like the bandwidth that I have to buy or to borrow. Okay.
Yeah. And one of the points that I wanna show here is that normally right now people are thinking, what can I qualify for? How can I qualify for? Can I qualify for anything right now? So right now I want to show what is the standard deal that I'm getting lately, right? I'm talking about a family income of $120,000, and I'm going to be talking regarding a client that has $25,000 down payment, only two debts, which is a car loan and a credit card for $5,000. So basically, this car loan they're paying $350 a month, and the credit card $150 a month. I wanna emphasize in this part because people sometimes they ask me, does it matter how much the debt I have? Of course it matters, but the most important part is how much are you paying monthly for those debts. So that's something that we consider when we're doing the application. We have to consider what's the monthly payment.
So it's less about how much in total you have on debt and more about what are your monthly payments.
Exactly.
So if you're in debt and you still want to buy a house, that means that you are still able to buy it, but the amount of payment per month, the lower they are, the easier it will be to you to get a property.
Correct.
Okay, gotcha.
And then I'm going to show you the property, right? So $120,000 income, how much you can qualify for. So knowing their debts already, I run my numbers, and basically a family with $120,000 income, they can qualify for a property up to $500,000.
$500,000.
Purchase price.
That 125 is gross, right? Like it's not the net income, not after taxes. That's before taxes.
That's the gross, yes.
Yeah. Okay.
I'm going to show the subject property now, and basically there's few points that we have to consider when it comes to calculating the numbers, and one of them is the taxes, annual taxes. So basically I put here for a townhouse, they're paying $4,000 a year.
$4,000, this actual family, $4,000 based on the $120,000 income. That's the monthly payment?
No, that's for property tax.
That's for property tax only. Okay.
Yeah.
And that's something people pay. Do they pay it like monthly, or is it add up to your mortgage? Is it something that you pay?
It's up to you and the lender. Some lenders, they want you to pay it.
Okay.
So you'll get the bill every 6 months or every 3 months, depends where you live, and they'll allow you to pay it. But if there's a risk for the lender, they'll collect the money from you, or they'll pay on your behalf.
Okay.
So it depends.
So it's on your mortgage, like whatever you pay for mortgage.
If you pay the mortgage,
yes,
then on top of, like whatever
the tax,
is in the mortgage is already included in it.
Yes.
Okay.
Yes.
And that's something that we have to consider when we run the numbers, because every town, every city, there are different taxes, property taxes, depending on the square footage, where it's located. So that's something important that we have to
amenities around, right?
Exactly, if there's any maintenance. And something that I also have to add in my application is their heating costs. How much are they paying for hydro? So basically, we have to consider that when we run the numbers. And also, I want to show you what will be the mortgage like for this property. So basically, now we know that the property price is $500,000, right? Mm-hmm. They're giving $25,000 down payment. Okay. So their first mortgage is going to be $475,000. But especially this deal is going to be an insured mortgage.
Okay.
So I'm going to explain now.
How do you know when it's an insured mortgage? Like, how does that work?
I'm going to explain now what's insured mortgage. So basically, an insured mortgage is any deal that is less than 20%. That's one of the rules. If you give less than 20% down, they'll make you buy an insurance mortgage, and you have to pay a premium for that insurance. Right. And it depends of the percentage that you're paying. If you're paying 5%, they'll make you pay 4% of the total purchase price, which is going to be $19,000.
Okay. On top of the cost of the property.
Property, okay. Exactly. So they're going to add it up to your loan. So you don't have to, if you want, you can pay it up front, but everyone, you just put it up on top of the first mortgage. So basically, I can show you here in my computer that their total amount is going to be for their first mortgage is going to be 475 plus 19,000. Total is going to be $494,000. That's going to be their first mortgage. So something that I want to talk about insurance mortgage is that some people, they ask me why I have to pay that. I don't want to pay insurance. Like, how can I avoid to pay the insurance mortgage? So it depends, right? If people have the 20% down, my advice is for them to pay it, and they don't have to have the mortgage.
And why is it that it is better to being able to do the 20% upfront rather than paying it? Because some people might be saying, well, you know what, like, I don't want to put the 20% down. That's a lot of money. And if I don't do it, then I can just pay things monthly. Does it make a difference? Like, how much of a difference is if I put the 20% or if I choose to pay it monthly?
Yeah, I think that's a personal decision. Yeah. But that's exactly what I want to do. I want to explain my clients their options, right? It's up to them.
Benefits.
Most of the people, to be honest, if they're first-time home buyers, they don't have the 20% down. So they'll say, you know what, I have to. There's no other way. I have to buy my first house, so I'll give.
In my case, that's what happened. We had to, because we didn't have the 20%. We had a 10%, so we ended up buying the insurance.
Exactly, but there's benefits if you buy the mortgage insurance. So I'll give you an example. If you buy the mortgage insurance, then you have to pay the lowest rate in the market for a mortgage. So that's one of the benefits.
So it helps you if you don't have to pay it. It benefits you, or if you have it.
If you buy the mortgage insurance, you'll get a better rate. Okay. That's one of the benefits that they have. If you don't have it, they'll give you a higher rate because it's a higher risk for the lender.
Right.
So something that I like to explain also to my clients is that this mortgage insurance covers the lender, benefits the lender, not you. So that's why they're giving you a better rate if you buy the home insurance.
Right, because the risk is lower. So it means that if I don't buy that, then they say, you're at a higher risk, so you have to, put you a higher interest rate.
Exactly. Okay. So that's really important because some people, they don't know exactly what are the benefits.
No, you said that it covers the bank. It does not cover me. So, for instance, if I don't have money to pay the mortgage for XYZ reason, it's not like that insurance is going to kick in and cover the debt for me. It is in case let's say the house is taken away and the government needs to sell, or the bank needs to sell the house. That is to cover any loss that they might incur from that transaction.
Yeah.
Okay.
And that's important because some people they get confused and they call me, oh, David, that's part of my life insurance, things like that. And they're like, no, I want to clarify that that's not part of that. So people, they need to be aware that there's other options out there when it comes to, having like a mortgage, personal insurance, or disability insurance. Mm-hmm. That's completely different. And one of the other things that I like to show to my clients is that there's different premiums, right? When it comes to paying the home insurance. And basically, if you give 5% down, the premium is 4%.
Right.
So in this case, they're giving $19,000. But I said to my clients, don't worry about it if that's the only option that you have, because you're going to save money on rent. Yeah. So you'll save that money in a year, so you don't have to give it back to the landlord or anything like that. It's your house. So after that, just stay.
It's a benefit.
It's a benefit. And right? I see the benefit. Now, it's up to the client what they want to do, right? In my opinion, if I have the money, if I have the 20%, I'll give the 20% because I know about mortgages, right? So I can see where are the options out there. But some people, they don't have the 20%. That's the only problem that we see in the market.
Will you recommend someone that doesn't have the 20% and only have a 5%? Because I've heard a lot of people saying, don't get into a house if you don't have at least 10% because, you're going to end up paying more and so on and so on. In the current situation that we are, in Canada, and where real estate is so expensive and it's not easy to get a mortgage approval, would you recommend to getting a property with a 5% down or not to get in the market at all?
No, they have to. I mean, if you're paying rent, I think my advice is to get into the market. You're going to be saving money at the end of the year.
Right. It's a savings.
Right now, we see that rents are so high. That was the point of paying rent. If you can qualify for a mortgage and buy a house, right? Mm-hmm. Yeah. That's how I see it. Right.
Yeah. You gotta start somewhere, right? Because you want to. If you buy a house with 5% down, you're gonna build equity on that house, and then later on you can maybe give the 20%. But if you don't start, like, it's very hard for people to just save 20% down, especially with the prices right now. So if you have it and you're renting, you're wasting your money on rent, I think it's something very advisable to do, right?
Now, I'm thinking about those ones who might not have an income of $120,000. And whoever is listening to it might be saying, well, I'm never going to buy a house because there is no way I'm going to be making $125,000. Now, if they don't have that $120,000 a year, does that mean that those people cannot buy a property? Or is there any, a standard income you could say, well, it depends on the debt, but this is the minimum that right now could get you to buy at least something out there?
Yeah. It depends on the city, right? Where you live, where you want to buy. But normally lately, the clients that have worked on, I see that they make around $80,000. That's the minimum, not debts, around $80,000. But it depends where you buy, right? You cannot compare Toronto with St. Catharines, Toronto with Barrie. So I think it depends where you want to buy.
So the reality is that there are options. People just need to think and evaluate what works for them, right?
To keep their options open, because a lot of people just want, they really stick to, I want to live in Toronto or very close to Toronto, right?
Yeah, because the other option they might have is, if they want to get into the house and they don't have the 20% or even the income, maybe they buy in a smaller place in, let's say Barrie or Aurelia, which is where I live, and that allows you to get in the market. You don't really need to live in that property if you don't want to, but you can have it and you can start being in the market, right? Don't give up on the opportunity just because you cannot buy in the city.
Because you cannot buy your dream home yet, right? Because a lot of people, they're thinking about their dream home and they wait until I save, but reality is homes keep going up, and things change so quickly. So, I mean, it's a dumb thing to do.
I think that is so smart what you just said.
Yes,
though. Yeah.
They're waiting for their dream house, and I mean, you gotta start somewhere. You gotta start somewhere.
Yeah. And one of the other points that we have to go through qualifying a client for a mortgage is the stress test.
More stress. We're already stressed. I don't want more stress.
So I think we started the stress test 5 years ago. And
what is the stress test?
So basically the government, they want you to qualify your client for 2% above the rate that you're getting from the lender.
Okay.
So basically, they're giving you, I'll give you an example in this deal, and they're giving you 4.99. So that's 5%.
That's 4% regular
Let's say
interest rate. Okay.
5%. And you have to add 2%. And that's the stress test.
So it's not like they're going to end up paying a 7%. It's just that the bank needs to know that, 4% is going to be your rate, but if something goes wrong, you have to have the capacity or the capability to pay up to 7%. So which is the example that we're living nowadays, where people locked in a rate of maybe 3%, 2% before, and now it's all the way to 5%. Hadn't they been calculated with that stress test, a lot of them wouldn't be able to pay the mortgage today.
Exactly. So before I used to hate it, but now it makes sense to me. Yeah. But something that I noticed, this is the part that I don't agree. If you're paying for your mortgage insurance, right? You're paying that much money. Why I have to qualify for the stress test also, right? Yes. Because at the end of the day, the mortgage insurance is already covers the lender.
Right. So, something happened is going to be covered. So why do I need to pay more?
So now if I don't pay the mortgage insurance, then use the stress test, right?
That makes sense.
So, but that's not what they're doing. So we have to follow by the rules.
And that stress test is said negotiable? Is that something that I can go and say, I don't want to pay it?
No. No. But the most important part is that I like to explain to my clients, because I like to show the application, right? they freak out. Like when they see, oh, my rate is 7%. I'm like, no. That's the stress test. Your mortgage rate is going to be 5%. So
but you need to qualify for a 7%,
7%,
just in case something happens.
So that's why a lot of people say, even though I'm making a lot of money, I only qualify for the X amount because it has 2 points above of what you should.
Yes.
Yeah.
Okay.
And something that I want to also show to my clients and my friends is that there's options out there to save money when it comes to paying off your mortgage, right? Some people, especially my clients at the beginning, I advise them to get monthly payments.
Okay.
That's what I said, to get monthly payments. And after you live in your house for 3 months, 4 months, see all the other options available out there so you can pay your home faster. Because some people, they want to buy a house and just live there, pay it off, and that's their game plan. So something that I like to show to them is that there's auctions out there, and there's a specific auction that they need to go through, which is accelerated bi-weekly payments. There's also a weekly and accelerated weekly, but normally I like to go with accelerated bi-weekly. And in this specific deal, I want to show you how much money they will save in 5 years.
Mm-hmm.
Because what's the benefit out of it, right? So I'll give you an example. Normally monthly payments is 12 payments a year, right? If we do it bi-weekly, it's 26 payments,
Mm-hmm.
right? Now, basically by paying 26 payments, you're paying an extra payment in a year.
So technically you're lowering your mortgage quicker or like in a higher value than what you would if you had 12 payments.
And the magic word is accelerated mortgage. So when you call your lender, you have to be specifically about what you want to do and what you want to pay.
Is that something that me as a buyer need to bring it up to you or call the bank, or is it something that you as a mortgage agent can?
Normally I explain this to my clients before closing, so they know what will be the difference and what are the options. Like I said again, normally I like to say, you know what, at the beginning while you settle, go monthly. After you find out what will be your utilities, your taxes, and all that stuff, if you feel comfortable, then change it to accelerated bi-weekly. And I show them what are the benefits out of it, right? And they can call their lender and request the change. Now, some lenders, they allow you to change that only once a year. Mm-hmm. Some of them charge us a minor fee to make the change. But having the option out there to pay your mortgage faster and save money, that's something that I like to show.
So your advice basically is if you have only a 5% for down payment, you go in the market with that. But then when you are talking about the method of payments or the frequency of those payments, start off on the monthly so that you get used to the expenses that you have for the house, which, by the way, it is a change, right? Because now you have to incur into maybe more expenses and you need a little bit of time to get adjusted to it, right? Now, after you feel that you understand how it works and all that, then you can go back to your mortgage agent and say, hey, can I change the frequency? Or is that something that now the buyer, the person who owns the house, need to reach directly to the mortgage?
Yeah, normally depends, right? If my client doesn't speak English at all, I'll help them out, translate, and call the lender. But if they can speak English, they can call themselves and make the change. And what are the benefits, right? So basically in this deal, I can show you the payment, right? The summary of the payments. And I can see that there's a savings of $16,000 in 5 years.
In 5 years, $16,000.
Yeah.
Wow. That is a lot of money, my friend. We can buy something and have fun.
Yeah.
Yes.
And also something that we noticed too when we run these numbers is that basically you're saving 5 months.
Wow. Hey, bro, right after this, we need to change that on my mortgage because I might have it monthly. And, did not know about that. So pretty helpful.
Yeah. So that's something that I like to go over, and especially people out there, right? If they want to save money, this is one of the options out there out of so many, which are they? Accelerated payments and also lump sum payments and payment increase. Some lenders allow you to do that. So it's on the agreement, on the commitment when you sign. They have other payment privilege.
Right.
And you need to go through those and see what are your options out there so you can save money. Right?
All right. Thank you, guys. Thank you, Alirio, for being here.
No, thank you. I learned a lot today.
Thank you, David, for sharing your knowledge with all of us. This is Financial GPS. I hope this podcast was very helpful and informative. We'll see you next time. Thank you.